on a random Tuesday in June. The most advanced cash flush artificial intelligence companies on the planet just, lost billions of dollars in market value. And this was in a matter of hours.
Right, yeah. And meanwhile, companies selling gas station pizza, dog food, and old school donuts made a killing.
Which is wild.
It really was a brutal reality check. I mean, the market woke up and basically decided the future is simply getting too expensive to build.
Welcome to today's deep dive. If you're managing a portfolio, running a business, or just trying to figure out why your cost of capital is suddenly acting completely erratic, consider us your personal research team.
Exactly. We are acting as your analysts today.
Because we are unpacking the market action from June 9 and June 10th, 2026. This was a 48-hour window where the whole hyper-growth narrative of AI slammed right into the absolute physical limits of corporate balance sheets.
And sticky inflation. Don't forget that. We had this incredible collision of forces, a violent rotation out of mega-cap tech, a massive healthcare acquisition, and inflation data that completely boxed in the Federal Reserve.
Not to mention a geopolitical shock in the Middle East that instantly repriced global risk.
Yeah, the whole board lit up at once.
Today, we are figuring out the mechanics behind all of it. Like, why a massive $7 billion capital raise essentially broke the semiconductor sector's momentum.
Right.
And why institutional money is suddenly flooding back into the most boring businesses imaginable. Plus, we'll look at how algorithmic trading bots pricing in a downed military helicopter are, directly influencing what you pay for a 30-year mortgage.
It's a textbook case of how interconnected the global capital structure has become. I mean, you can't look at NVIDIA's cash flow in a vacuum without looking at what's happening in the Strait of Hormuz.
You really can't. Okay, let's unpack this.
Let's do it.
Let's start with the intraday action on Tuesday, June 9, because the headline numbers completely lie to you.
Oh, totally. They hide all the bodies.
Right. If you just check the closing bell, the S&P 500 closed down 0.25%, settling just under 7,400. You'd think, well, quiet summer Tuesday.
Right. Just a rounding error. Nothing to see here.
But the tape from that day tells a terrifying story. The index careened from strong early gains into a massive 2.5% plunge right in the middle of the trading session.
It was a violent recalibration. I mean, we saw huge blocks of institutional selling hitting the bid all at once.
Just indiscriminate dumping.
Basically, yeah. But the really crucial detail isn't the drop itself. It's exactly what was being sold and what was being bought.
Yeah.
The market didn't move as a monolith at all.
Not even close. The Nasdaq 100, which is heavily weighted toward tech, dropped over a full percent, pushing down below 29,000. But the Dow Jones Industrial Average, the old guard blue chips, actually climbed, closing up above 50,000.
And that divergence, that's the key to understanding the entire week.
Yeah.
If you were heavily concentrated in the Nasdaq, it felt like an absolute bloodbath. But if you look at market breadth, like the actual participation rate across the broader indices, it was shockingly robust.
Right, because nearly 3 out of every 4 stocks in the S&P 500 actually closed in the green that day.
Exactly. 3/4 of the market went up.
I always find that dynamic fascinating. The major headline index is technically in the red. The financial media is flashing all these warning signs. But 75% of the underlying companies are having a great day.
Well, because the index is market cap weighted.
Right.
So the big guys dictate the whole mood.
Yes. When the multi-trillion-dollar tech behemoths sneeze, the index catches a cold, even if the vast majority of the other 490 companies are perfectly healthy. And the really aggressive buying wasn't even in the large caps.
Where was it?
The S&P small cap 600 pushed up a full percent. The mid cap 400 was right behind it.
Wait, so institutional capital wasn't fleeing the stock market entirely and rushing into cash or treasuries?
No, not at all.
They were just moving out of the penthouse and buying up the ground floor apartments?
Oh.
That's a great way to put it. This was a classic aggressive sector rotation. The capital allocators hit the sell button on mega cap growth and immediately deployed that liquidity into smaller, value-oriented companies.
It's like a seesaw. For the last 2 years, the giant tech kids have been sitting on one side, keeping everyone else suspended in the air.
Yeah.
Now they've suddenly hopped off, and the rest of the playground is slamming back down to earth.
That's exactly what it looked like on the charts.
But why now? What exactly spooked the tech giants so badly on this specific Tuesday? And why small caps? Usually when volatility spikes and tech sells off, people want safety.
Right, they go to gold or bonds.
Exactly. Small caps are inherently riskier. They are way more sensitive to domestic economic shocks. So what gave institutions the green light to buy the small guys?
Well, the trigger was buried in the macroeconomic data that morning, specifically the NFIB Expected Credit Conditions Index.
Oh, yeah.
Yeah, showed an improvement. It moved from a baseline of -5 up to -3.
Wait, -3 still means credit conditions are tightening, right?
Technically, yes.
It just means things are getting worse at a slightly slower pace.
Right.
So why is a negative reading triggering a massive buy program?
Because the market trades on the second derivative, right? The rate of change.
Huh. Well, less bad is good.
Exactly. Less bad is incredibly good. Look, small and medium-sized businesses don't have the luxury of floating billion-dollar corporate bonds in the public markets like Apple or Microsoft can.
Right, they can't just call up Wall Street.
No, they rely on regional bank loans, revolving credit facilities, and floating rate debt. And for the last 2 years, they have been absolutely choked by high borrowing costs and tightening lending standards.
So a 2-point improvement in that expected credit metric is essentially a signal that the worst of the credit crunch for Main Street might actually be in the rearview mirror.
That's the algorithmic interpretation. If regional banks are even marginally more willing to extend credit, these small-cap companies can refinance debt, they can invest in inventory, or honestly just survive without suffocating on interest payments.
Wow.
So the algorithmic models ingest that NFIB data and instantly initiate a rotation out of the cash-rich tech giants and into the heavily discounted small caps.
It's like a massive pressure valve being released.
Completely.
But I want to zero in on the other side of that trade. The tech giants were the source of funds for this rotation, and the catalyst for that massive tech sell-off came from a single company.
Yep. Supermicrocomputer,
Yeah.
SMCI.
Right. For those who don't know, they are effectively the general contractors of the AI build-out.
That's an analogy.
They manufacture these incredibly dense, high-performance server racks that house the advanced GPUs powering large language models, and they just reported a backlog of $39 billion in AI server orders.
The staggering number. I mean, it represents years of locked-in revenue.
And yet, on Tuesday morning, they announced a $7 billion financing package, and the market absolutely eviscerated them for it.
Just tore them apart.
The stock plunged 9.5% right out of the gate. And over the next 48 hours, it lost over a quarter of its total value, dragging the entire tech sector down with it.
Yeah, to understand the violence of that market reaction, we have to pull apart the mechanics of that $7 billion package.
Let's do it.
It wasn't standard corporate debt. It was heavily, aggressively dilutive.
Let's break down the prospectus. It was structured in 3 tranches, right? First, a $1.25 billion common stock offering.
Which is immediate dilution.
Right. Second, $3.75 billion in depository preferred shares that automatically convert into common stock in June 2029.
Uh-huh.
And finally, a $2 billion at the market, or ATM, equity program.
And the combination of those 3 mechanisms fundamentally alters the capitalization table of the company. Well, you're taking the existing shareholders, the people who rigged the stock up, believing in this whole AI supercycle, and you are forcibly shrinking their slice of the pie.
Because you're just printing more slices.
Exactly. The math worked out so that prior shareholder ownership dropped from a full 100% down to roughly 77.5% of the company.
That is a brutal haircut. But here is where the logic breaks down for me.
Okay, what is it?
If I'm running a company with $39 billion in contracted, guaranteed orders from the biggest tech hyperscalers in the world, I'm talking Meta, Microsoft, Amazon, why on earth am I resorting to a highly punitive equity raise?
It's a great question.
Why wouldn't a syndicate of major investment banks look at that backlog and happily issue standard corporate debt at, say, 7 or 8%?
Yeah.
Why destroy your own stock price like that?
It comes down to the brutal math of the cash conversion cycle in hardware manufacturing.
Okay, walk me through it.
SMCI's balance sheet tells a completely different story than their income statement. From 2022 to the third quarter of 2026, their accounting profit, the net earnings they report to Wall Street, was a very healthy $4.18 billion.
Right. On paper, they look highly profitable.
On paper. But over that exact same period, their operational cash flow was negative $8.16 billion.
Wait, really? How does a company book $4 billion in profit while simultaneously bleeding $8 billion in actual cash?
Because of the timeline of how money moves in the physical supply chain. Think about the logistics of building a multi-million-dollar AI server rack. Before SMCI can assemble it, they have to buy thousands of ultra-expensive GPUs from NVIDIA.
And NVIDIA dictates the terms.
Completely. NVIDIA demands cash, likely on incredibly tight terms, maybe net 30 days. So SMCI wires billions of dollars to NVIDIA today.
Okay.
Then SMCI has to take physical delivery, assemble the liquid-cooled racks, test them, and then ship them to a massive data center in, say, Virginia. That physical process takes months.
And they still haven't been paid by their customer.
Exactly. Then the hyperscaler receives the server, provisions it, and pays SMCI on a net 90 or even net 120-day cycle.
Oh.
So SMCI's cash goes out the door on day 1, but the revenue doesn't come back until day 150.
Oh, I see. It's like a local contractor who wins a massive bid to build an entire subdivision.
Yes.
It's the best news they've ever had, but they suddenly have to buy millions of dollars in lumber, copper, and concrete on their own credit lines months before the developer actually cuts them a check for the finished houses.
That's the perfect analogy. And if that contractor's backlog suddenly grows from a few houses to an entire city, which is what SMCI's $39 billion backlog represents, that working capital drain becomes a black hole.
They're dying of success.
Basically, they literally ran out of physical cash to buy the parts needed to fulfill their own orders.
But why equity and not debt? Why not just get a giant loan to cover the gap?
Because traditional banks look at that negative $8 billion cash burn and bulk.
Even with the guaranteed orders.
Yes, because debt requires regular, predictable interest payments. If your cash is locked up in physical inventory sitting in a warehouse, you can't service a massive debt load.
So the banks say no.
The banks say no. So the only way to plug a multi-billion-dollar working capital hole without triggering a liquidity crisis is to issue equity. You sell pieces of the company to investors who are willing to wait for the payoff.
Which explains the specific structure of those preferred shares. $3.75 billion in depository preferreds that convert in 2029.
Exactly. It's a bridge. Institutional investors buy the preferred shares because they get a guaranteed dividend yield right now, with the promise that in 3 years, when SMCI has theoretically worked through this massive backlog and normalized their cash flow,
those shares convert to common equity, and they get the upside of the stock appreciation.
Precisely.
And what about the $2 billion ATM program?
Ah, the ATM. An at-the-market offering is essentially a spigot the company installs directly into the public markets.
How does that work?
They don't have to announce a massive block sale. If the stock happens to rally on a random Thursday, they could just quietly turn on the spigot, issue a few million shares at the prevailing market price, and siphon cash directly onto their balance sheet.
It's brilliant for the company's survival,
Yeah.
but incredibly toxic for the existing retail shareholder who is just getting constantly diluted.
Yes, you're just constantly bleeding ownership.
And this realization that the AI build-out is fundamentally a cash incinerator for the hardware assemblers is what broke the market's fever.
Totally, because contagion in the semiconductor space happens faster than almost any other sector.
Why is that?
Because the supply chain is so tightly coupled. When investors realized that capital expenditures in the hardware layer were vastly outpacing cash generation, they didn't just dump SMCI. They aggressively de-risked their entire semiconductor portfolios.
The ripple effects were brutal. I mean, Micron Technology, the massive memory chip maker, dropped 10% midday before clawing back to close down slightly.
Yeah, that was wild.
Marvell got hit for nearly 8%. AMD dropped 4%.
Because memory chips and networking components face the exact same working capital dynamics. You
Yeah.
have to build the fabs, buy the silicon, and float the inventory.
But the one that really stood out to me was Taiwan Semiconductor, TSMC.
Oh, yeah.
They actually dropped 3% on the day, despite the fact that they simultaneously reported a 30% jump in their May revenue.
Which is a phenomenal earnings report.
Right. They're literally printing money, beating expectations, and the market sold them anyway.
Well, in a liquidity scare, fundamental data like a strong monthly revenue print gets completely ignored.
It just doesn't matter.
It doesn't matter. When massive institutional funds decide to reduce their exposure to a specific factor in this case, hardware capital intensity, they just sell the sector ETFs.
Yeah.
TSMC gets sold mechanically, regardless of their individual performance.
It's just algorithms dumping the whole basket.
Exactly.
And it even bled over into the software side. Oracle dropped 3% heading into their earnings.
Because Oracle is on the hook to build out massive cloud infrastructure. Analysts began modeling out what Oracle's capital expenditures would look like if hardware costs are spiraling.
What was the projection?
The projection was that Oracle would have to jump their CapEx spend by 30% just to maintain their current trajectory.
Which means less free cash flow for share buybacks or dividends. The cost of admission to the AI race is getting so high that the market is beginning to question the return on investment.
But there is one glaring exception to all this. The apex predator of the entire ecosystem.
NVIDIA.
Always NVIDIA.
While the entire semiconductor supply chain was having a meltdown over working capital, NVIDIA barely registered a pulse. Their stock dropped roughly 0.2%. They were practically immune to the sell-off.
Because of where they sit in the value capture hierarchy, Bank of America released an estimate during this volatility that completely explains NVIDIA's resilience.
What did they find?
They project NVIDIA will generate over $400 billion in free cash flow over the next 2 years.
$400 billion in free cash flow. Not revenue. Cash.
Cash. Pure cash.
Yeah.
You put that in perspective, that is more free cash flow than Apple and Microsoft are projected to generate combined.
That is, it's hard to even wrap your head around that level of profitability. How does NVIDIA generate that much cash when the companies buying their chips are going broke trying to afford them?
Because NVIDIA's the toll booth. They don't have the same intensive assembly, testing, and shipping bottlenecks as an SMCI.
Right.
They design the silicon, outsource the manufacturing to TSMC, and then sell the finished GPU at an astronomical gross margin. Because their architecture, specifically the CUDA software layer, is the industry standard.
They possess absolute pricing power.
Absolute.
So SMCI has to scramble and dilute their shareholders to find the cash to pay NVIDIA. And NVIDIA just sits back and collects the wire transfers.
Precisely. In a gold rush, the market eventually figures out that owning the mining operation is a terrible capital-intensive business with massive execution risk. You want to own the company that has a monopoly on selling the heavy machinery.
NVIDIA is selling the pickaxes for the gold rush, but Supermicro is the guy who has to buy 10,000 pickaxes up front at retail price before he can even start his mining company.
That is exactly it.
But the problem with monopolies is that eventually the customers start looking for a way out. And we are starting to see the first real cracks in the NVIDIA at all costs narrative.
Right, because of the corporate realization that implementing ultra-high-end AI is dramatically more expensive than the initial pilot programs suggested.
The inference costs the actual daily operational cost of running a massive AI model to answer user queries are staggering. Power consumption alone is blowing out IT budgets.
Yeah, the data center power requirements are off the charts.
You saw this explicitly with companies like Uber. They ran the numbers on integrating top-tier, multi-trillion parameter language models into their routing and customer service algorithms and realized the math simply doesn't work.
It costs too much compute for the marginal gain in efficiency.
Right. You don't need a supercomputer to calculate the fastest route for a food delivery driver.
No, you really don't. And the sticker shock is cracking open the door for a massive new subsector budget. High-efficiency AI.
And the fascinating part is where this innovation is coming from. China's DeepSeek was highlighted specifically as capturing this new demand.
Yeah, DeepSeek is taking a fundamentally different engineering approach, while companies in the U.S. are essentially using brute force, throwing tens of thousands of expensive NVIDIA chips at massive parameter models.
DeepSeek is optimizing for architectural efficiency.
Right. They are building models that can run on significantly less hardware, using techniques like sparse mixture of experts.
How does that work?
Well, only a tiny fraction of the neural network is activated for any given task. So instead of lighting up the whole brain to answer a simple question, it only uses the part it needs, saving massive amounts of compute.
It's the democratization of the technology. The initial wave was about proving the capability. Now, the enterprise market is demanding cost-effectiveness. But the appetite for the bleeding edge hasn't completely vanished, has it? Because while the public hardware markets were melting down over cash flow, the private markets were still incredibly active.
Oh, completely.
The filings indicate both OpenAI and SpaceX are actively prepping for IPOs.
The distinction there is between infrastructure and application. The market is exhausted by the companies burning cash to lay the pipes, but there is still massive pent-up demand to invest in the visionary companies that will actually own the end-user relationship.
Right.
An OpenAI IPO would be the defining liquidity event of the decade.
But let's pivot, because the most fascinating part of this specific week wasn't just the tech sell-off. It was where all that capital actually went.
Right, the rotation.
While the engineers and data scientists were sweating over inference costs, the most profoundly boring businesses in the economy were printing money.
The revenge of the tangible economy.
Exactly. The J.M. Smucker Company, they make Folgers coffee, Uncrustables, Hostess Twinkies.
Yep.
Their stock ripped higher by over 10% in a single day.
They posted a massive earnings beat. And the mechanism behind that beat is the holy grail of corporate finance right now.
Pricing power.
Pricing power. They successfully passed on higher raw material costs directly to the consumer without losing sales volume.
Think about the psychology of the consumer right now. In a persistent inflationary environment, discretionary spending gets crushed. But habits are incredibly sticky.
Right. I might delay buying a new car, but I'm still buying my morning coffee.
And you're still packing a peanut butter and jelly sandwich in your kid's lunchbox.
Exactly. And Smucker knows that. When the wholesale price of coffee beans or sugar spikes, they just raise the price of a jar of Folgers on the supermarket shelf.
Because what are you going to do? Not drink coffee?
Right, because the product is an inexpensive daily staple. The consumer grumbles, but they still put it in the cart. Smucker protects their profit margins, generating immediate, predictable cash flow.
And in a market terrified by the opaque negative $8 billion cash burn of an AI server company, a coffee company that generates positive free cash flow every single day looks like an absolute safe haven.
It wasn't an isolated event either. Look at Casey's General Stores.
Right, a massive regional chain of convenience stores and gas stations. They sell pizza by the slice and energy drinks.
And they just bumped up their dividend and announced a $1 billion stock buyback program.
Wow.
The stock immediately climbed. When a company has $1 billion in excess cash to return to shareholders, it signals supreme confidence in their underlying business model.
And Chewy, the online pet food retailer, also rallied 4% on the back of significantly upgraded margin guidance.
People will skip a vacation before they stop feeding their dog.
Precisely. But it's crucial to note that this wasn't a blanket rally across everything consumer-related.
No, it wasn't. Nike took a hit.
Yeah, the stock fell nearly 2% after a major downgrade from analysts at RBC Capital.
Which highlights the exact line the consumer is drawing right now. Coffee, gas station snacks, and pet food are non-negotiable.
But a $250 pair of new sneakers.
Highly discretionary. RBC noted that Nike's turnaround strategy is materializing much slower than anticipated because the core consumer is actively trading down in the apparel space.
So we have this bifurcation. The consumer is resilient, but they are ruthlessly prioritizing.
Exactly.
But the rotation wasn't just about hiding in defensive consumer staples. We also saw massive capital deployment in the healthcare sector, specifically a colossal M&A deal.
Oh, this was huge. GlaxoSmithKline, GSK, announced a definitive agreement to acquire a Massachusetts-based clinical-stage biopharmaceutical company called Nuvalent.
The price tag on this deal is staggering, $10.6 billion in cash. They paid $124 a share, which represented a 40% premium over where the stock was trading.
It is a massive allocation of capital, and it reveals exactly how big pharma operates in the modern era. They function less like internal research and development labs and more like late-stage venture capital firms.
Let's look at the math behind that $10 billion check, because to a layman, it looks insane.
It really does.
They are buying Nuvalent primarily for two precision oncology lung cancer drugs, zetomipzomib and neladalkib. But neither of these drugs has actually cleared the FDA yet.
They are still in the regulatory pipeline.
So GSK is gambling $10.6 billion of shareholder cash on the assumption that a government agency will approve these drugs later this year. What happens if the FDA demands another clinical trial or finds a safety signal?
The entire investment goes up in smoke.
Right. Why take that risk?
Because the alternative is guaranteed revenue collapse.
What do you mean?
GSK is currently heavily reliant on a blockbuster HIV drug called dilution. It is a massive cash cow for them. But the pharmaceutical industry operates on a ticking clock called the patent cliff. Under the Hatch-Waxman Act, once a drug's exclusivity period expires, generic manufacturers can flood the market with cheap copies, and the original creator's revenue drops by 80 or 90% almost overnight.
And dilution exclusivity expires soon.
Between 2028 and 2030.
Oh, wow. So they are staring down a multi-billion-dollar revenue creator that is guaranteed to happen in just a few years.
Yes. They don't have the time to invent a new drug from scratch, put it through 10 years of clinical trials, and hope it works. They have to buy revenue that is already de-risked.
Which brings us back to Nuvalent.
Nuvalent specializes in targeted kinase inhibitors. These specific drugs are designed to bypass the resistance mutations that tumors inevitably develop, and crucially, they can cross the blood-brain barrier.
Okay, so the science is solid.
The clinical trial data was incredibly compelling. Both drugs have FDA target action dates set for late 2026, September and November.
So GSK's internal modeling calculates the net present value of those future oncology revenues, assigns a probability of FDA approval, say 90% based on the phase 2 and 3 data, and decides that paying a 40% premium today is cheaper than facing a revenue collapse in 2028.
Exactly. If the FDA approves them this fall, GSK can immediately plug them into their massive global distribution network, and they project those drugs will be aggressively contributing to top-line growth by 2027. It perfectly offsets the HIV patent cliff.
It's a fascinating juxtaposition. You have tech companies diluting their own stock because they ran out of cash to buy computer parts, and you have big pharma aggressively deploying $10 billion cash reserves to buy the future.
But, there is a macro headwind that both of these sectors are violently fighting against, a force that dictates the cost of that $10 billion and dictates the profit margin on Smucker's coffee.
Inflation.
Yep.
The economic data drop that happened right in the middle of this market rotation was the May Consumer Price Index, the CPI, and the numbers were deeply unsettling.
The headline inflation figure hit 4.2% year over year. Month over month, it rose 0.5%.
4.2%. I mean, we aren't in the nightmarish double-digit inflation we saw a few years ago, but 4.2 is more than double the Federal Reserve's official 2% target. The inflation ghost is refusing to leave the building.
And when you look at the internal components of the CPI basket, the narrative gets incredibly complex. Core CPI, which is the metric the Fed prefers to look at because it strips out the highly volatile food and energy sectors, was actually much lower, at 2.9% year over year.
See, I always have to push back on the concept of core CPI. I know economists love it because it shows the underlying trend, but average people don't live in a core economy.
That's true.
We have to heat our homes, we have to put gas in our cars, and we have to buy groceries. Stripping out the things we spend the most money on feels like academic gaslighting.
It's a fair criticism. The argument for core CPI is that the Federal Reserve's tool interest rates can't drill for oil or make it rain on wheat fields.
Right.
Raising rates doesn't fix a supply shock in commodities, so they focus on core to see if the inflation is embedded in the service sector or wages, which they can control.
But the headline number is what consumers actually feel. And the spread between the 4.2% headline and the 2.9% core tells us exactly what is breaking the consumer's back right now.
Energy.
Gas prices at the pump surged an unbelievable 40.5% year over year. Energy alone accounted for over 60% of the total monthly increase in the entire inflation print.
The physical goods category, things like electronics, apparel, used cars, was basically flat. The supply chains have normalized.
Okay, so that's good news.
But shelter costs, driven by the structural shortage in housing and the owner's equivalent rent calculation, remain incredibly sticky, rising 0.3% for the month.
Inflation is essentially acting like a waterbed.
How so?
The Fed stepped hard on the good side of the bed, raising rates and crushing demand for physical stuff. But the pressure just transferred, and the energy and shelter side of the bed bulged right up.
That is exactly what's happening. And the danger of energy inflation is that it infects everything else.
Because it's an input cost.
Right. The Producer Price Index, the PPI, tracks wholesale cost before they reach the consumer. If diesel fuel spikes 40%, the cost to run a logistics fleet spikes. The cost to run a heavy manufacturing plant spikes.
The cost to cool a massive AI data center spikes.
Exactly. Those wholesale costs inevitably get passed down to the consumer, which means that flat goods number in the CPI won't stay flat for long, and this dynamic completely paralyzes the Federal Reserve.
The Fed funds target rate is currently sitting at 3.50 to 3.75%. Following the CPI report, the futures markets, which track where institutional money is betting rates, will go priced in a massive 98.2% probability that the Fed does absolutely nothing at their next meeting.
A total pause. They can't cut rates because headline inflation is accelerating toward 5%.
But they are terrified of hiking rates further because the banking sector and the commercial real estate markets are already buckling under current rates.
Exactly. They're trapped in a holding pattern.
And that holding pattern is keeping the bond market elevated. The 10-year Treasury yield, which is the benchmark for global borrowing, eased off slightly during the week to 4.53%.
Which is high, but the context is crucial. Before the current geopolitical conflicts escalated, the 10-year was trading around a 3.97% base.
So we're essentially dealing with a permanently elevated floor for interest rates. And this brings us to the math of why the stock market felt so fragile this week. It's all about the equity risk premium.
Yes, the equity risk premium. It's the excess return an investor demands to take on the risk of buying stocks instead of just parking their cash in risk-free government bonds.
Right. If I can get a guaranteed 4.5% from the U.S. Treasury, the stock market needs to offer me a significantly higher expected return to justify the fact that I might lose my principal.
But it isn't offering that. The forward price-to-earnings ratio of the S&P 500 is sitting at roughly 20.2. If you invert that, you get an earnings yield of about 4.9%.
Okay.
When you compare that to a 4.5% risk-free rate, the premium is razor-thin.
There's almost no margin of safety.
None. Valuations are priced for absolute perfection. If a company misses earnings, or if they suddenly announce they are burning $8 billion in cash like SMCI.
The market doesn't just correct, it aggressively liquidates the position because there is no fundamental valuation floor supporting it at these interest rates.
And the derivative markets were screaming that this fragility was hitting a breaking point.
Yeah, the VIX, which tracks implied volatility on the S&P 500 over the next 30 days, climbed up near 20. But the real panic was happening in the ultra short-term options.
The VIX 1D.
Right, the one-day volatility index. It tracks the pricing of 0 days to expiration options, the 0 DTEs. That index spiked nearly 29% in a single session.
It created a fascinating dynamic called an inverted volatility curve.
Let's unpack that, because usually time equals uncertainty. If I ask you what the market will do tomorrow, you might have a good guess. If I ask you what it will do in 3 years, you have no idea. So long-term options should always be more expensive than short-term options.
Right. In a normal market, the curve slopes upward. It's called contango.
Contango, right.
But when the VIX 1D spikes higher than the traditional 30-day VIX, the curve inverts. The market structure is telling you that the immediate present is perceived as significantly more dangerous than the distant future.
Institutions weren't buying protection for a recession next year. They were panic buying puts to protect their portfolios from collapsing by Friday.
Because they knew the CPI print was coming. But more importantly, they were watching the raw feed of geopolitical headlines.
Which brings us to the actual root cause of this entire macro domino effect. If the core CPI is low, but the headline CPI is high because gas prices spiked 40%, we have to look at what is driving the oil shock.
The physical commodity markets.
Early in the Tuesday trading session, global oil actually looked like it was going to break lower. Brent crude dropped 3%, falling toward $91 a barrel.
And the sell-off was triggered by algorithms instantly parsing comments from Donald Trump, who suggested that a U.S.-Iran diplomatic agreement was imminent.
Like potentially within days.
Right, which would secure and reopen the Strait of Hormuz.
And the Strait of Hormuz is the single most critical choke point in the global energy supply chain. Roughly 20% of the world's total oil consumption passes through that narrow waterway. When it is threatened, the risk premium on every barrel of oil globally skyrockets.
So the algorithmic trading bots read the word agreement in the headline feed, instantly shorted crude futures, and the price dropped. The market was pricing in a de-escalation.
For a few hours, the relief was palpable. Lower oil means lower inflation, which means the Fed can cut rates, which means the equity risk premium expands. It's a virtuous cycle.
But then the reality of the physical world intervened, and the algorithmic bot violently reversed course. Oil surged right back up, with West Texas Intermediate pushing back toward $90.
The catalyst for the reversal was a confirmed military engagement. U.S. Central Command announced they had executed defensive strikes in the region.
And shortly after, Trump reported that a U.S. military helicopter had been downed by Iran, explicitly stating that the United States must respond.
It is a perfect example of how high-frequency trading operates. A human trader sees that headline, takes a breath, thinks about the political implications, and then decides to buy oil.
By the time the human clicks the mouse, the algorithms have already bought thousands of contracts. They've parsed the phrase "must respond" using natural language processing, categorized it as an escalation probability, and bid the price of crude up by $1.
The speed is terrifying. But the longer-term consequence is what happens to that 10-year Treasury yield. We talked about it sitting at 4.53%.
It is baking in a permanent geopolitical risk premium. The bond market is a highly efficient discounting mechanism.
Right.
It is looking at the instability in the Middle East, the structural shifts in global trade, and deciding that the baseline level of risk in the world has fundamentally increased. Therefore, the baseline cost of borrowing money must increase.
And that increased cost of capital is creating massive fractures in the global economy. Different regions are handling the pressure in completely different ways.
We are seeing a historic macro divergence. Look at Europe.
Europe is looking incredibly fragile right now. German factory orders for April were released, and they dropped a sharp 3.8% month over month.
Germany is the industrial engine of the Eurozone. If their factories are slowing down that aggressively, it signals deep structural stagnation across the continent.
The energy shock hits Europe much harder than the US because they don't have domestic shale production to fall back on. Their industrial base is suffocating under high energy input costs.
Yet, despite this massive economic slowdown, the European Central Bank is widely expected to hike interest rates at their next meeting.
That seems like economic suicide.
Mhm.
You have a stagnating manufacturing base, and you are going to raise the cost of borrowing money.
It's the mandate trap. Their inflation is also proving sticky, driven by those exact same global energy costs. They have to hike rates to defend the currency and fight inflation, even if it forces their economy into a deeper recession.
But then you look east, and the data out of China completely shatters the consensus narrative.
Oh, totally. Chinese May exports were up 14.1% year over year.
Which is strong, but the internal breakdown is what blew my mind. Their exports specifically to the United States surged 35.4%. That is the strongest growth rate in over 5 years.
It completely defies the prevailing political narrative.
Right. For years, the dominant thesis on Wall Street and in Washington has been decoupling. Tariffs, supply chain nearshoring, fracturing global trade. Yet here is the raw data showing that China is shipping 35% more goods to the U.S. consumer than they were last year. How is that mechanically possible with the current tariff regime?
Two reasons. First, the U.S. consumer is the engine of the global economy, and despite inflation, they are still spending. Second, importers often front-run geopolitical friction.
Front-run it? How?
If companies anticipate that new, heavier tariffs are coming down the pipeline, they massively accelerate their purchase orders to get the inventory to U.S. warehouses before the tax goes into effect.
They pull future demand forward.
Exactly. And crucially, a significant portion of that export bone was tied to technology and infrastructure components.
Which circles us perfectly back to supermicrocomputer. SMCI is trying to build $39 billion worth of AI server racks. To do that, they need raw materials, cabling, cooling systems, and subcomponents. A vast amount of that physical supply chain still originates in Shenzhen.
The global economy is a closed loop. You can't decouple the AI revolution in Silicon Valley from the manufacturing floors in Guangdong.
And the ultimate scoreboard for all these massive competing macro forces is the currency market.
The U.S. dollar index, the DXY,
It consolidated just below the 100 level. The dollar remains structurally incredibly strong.
because capital flows to where it is traded best. If the U.S. economy is showing resilience and the Fed is keeping rates high while Europe stagnates, global capital flees the euro and buys dollars to capture that 4.5% treasury yield.
And that exact dynamic was devastating for gold this week. Gold dropped 2.2% down to roughly $4,160 an ounce.
Gold is a non-yielding asset. It doesn't pay a dividend. It doesn't pay interest. Its primary function is a hedge against currency debasement or negative real yields.
But right now, real yields, which is the nominal interest rate minus the inflation rate, are firmly positive.
If I can get a guaranteed return in U.S. dollars that beats inflation, the opportunity cost of holding a heavy brick of yellow metal is simply too high. Institutions dumped gold and bought the dollar.
It all connects. The dollar strength, the Chinese exports, the Middle East oil shock, the SMCI cash burn. They are all nodes on the exact same network.
Which brings our deep dive for today to a close. We started by looking at the architects of the AI revolution, suddenly hitting a brick wall.
They realize that hypergrowth is meaningless if you are burning through billions of dollars in working capital just to buy the physical hardware to sustain it.
We watched institutional capital violently rotate out of that speculative growth and seek shelter in the tangible economy, buying companies with immense pricing power, like Smucker passing on the cost of coffee.
Or GlaxoSmithKline leveraging billions in cash to acquire de-risked oncology revenue.
But hovering above all of this capital allocation is the Federal Reserve, paralyzed by a 40% spike in gas prices driven directly by geopolitical crosshairs in the Middle East.
It's an environment where capital is expensive and mistakes are ruthlessly punished.
The era of zero interest rate policy, where you could fund a company purely on a compelling narrative and a sleek pitch deck, is completely dead.
We have decisively entered a show me the cash flow market. Balance sheet strength, immediate free cash flow generation, and physical operational efficiency are the only metrics that matter now.
You can't just promise to change the world. You have to prove you can afford the lumber to build it.
Precisely. As we wrap up, I want to leave you with one final thought to ponder. We talked a lot today about the physical bottleneck in AI. NVIDIA's top-tier chips are the undisputed gold standard, and they hold absolute pricing power because they are the gatekeepers.
Generating $400 billion in cash because everyone has to play by their rules.
Right. But we also discussed how that extreme cost is forcing companies to look for alternatives. And we noted that China's DeepSeek is aggressively stepping in to offer highly efficient budget AI architectures for tasks that don't require supercomputers.
Driven in large part by necessity, because heavy U.S. embargoes severely restrict the export of top-tier NVIDIA hardware to Chinese firms.
Exactly. So think about the mechanics of that policy. The United States implemented those embargoes to starve China of the most powerful hardware, theoretically to cripple their ability to compete in the AI race.
Uh-huh.
But if the global enterprise market companies like Uber is deciding that top-tier AI is fundamentally too expensive to run anyway, and they are actively demanding cheaper, leaner, more efficient alternatives,
The market wants a scalpel, not a sledgehammer.
are the very sanctions designed to hold China back actually forcing them to capture the most lucrative, high-volume segment of the future market?
Mm.
By denying them access to the sledgehammer, did we force them to perfect the scalpel? And when the enterprise world decides they only want to pay for scalpels,
Who owns the market?
constraint breeds the most dangerous kind of innovation.
The market's mechanics always find a way to surprise us.
Thank you for taking the deep dive with us today. We'll see you next time.